Now on stage, Volatility Beyond Borders, Exposure Management for Greek Businesses. Moderating the discussion, Adiola Mehalla, Treasury Director at Sani Ikos Group. Joining her on stage, Bill Amanatidis, Treasurer at Goodman Fielder, Kerim Sunguroglou, Product Success Manager at 360T, Faidon Dimitriadis, Group Treasury, Head of Financial Risk Management at HelleniQ, Gilles Bonlong, Director at Centrus. Please welcome our moderator and speakers.
Hi everyone, good morning. Good morning to our session, Volatility Beyond Borders, Exposure Management for Greek Businesses. I will not introduce myself and our panel since it already took place, but for you to know the structure of our discussion, Bill and Faidon are going to be outlining the issues that treasurers face on FX risk management, while Kerim and Gilles are going to show how they can support with processes, tools, and expertise. Bill, I'll start our discussion by addressing my first question to you. Treasurers often say that getting a clear picture of exposure, of FX exposure, is the foundation of effective risk management. From your experience, what makes it so difficult to get accurate and timely exposure information, and how does this impact the hedging decisions?
Hi, Adiola. Thanks for the question. I couldn't agree more. Obtaining accurate and timely exposure information is critical and is the cornerstone of risk management, effective risk management anyway. But you can get difficulties in getting this information. One of firstly, working in a multinational corporation, we have different business units operating in different countries, which gives rise to different currency risks, different economic risks, and different transaction risks. Trying to collate information from a varied operations can be difficult. We need an ERP system, which even if an advanced ERP system has its issues because you're still relying on information being uploaded and coming across. One part of the business might be providing you information, on time. The other part of the business is delayed, and trying to aggregate that exposure can become troublesome, and you can't put in hedges in place due to things like that. I guess the next thing is, we operate with fragmented systems. Trying to get your ERP system to link with your treasury system sometimes doesn't work, requires manual inputs, manual uploads, and therefore you're not getting accurate information. And we're still in a world where we rely on Excel spreadsheets way too much. Everybody uses them every day, and no matter how hard it is, how you try to get rid of it, you keep coming back to an Excel spreadsheet. Beyond your systems, you have your communication gaps, and lack with your business unit. So a perfect example is you have a procurement team that may have a contract that is in local currency, so it might be a euro contract. But deep in the contract there's a link to a US dollar exposure. So procurement team rightly thinks it's euro. I don't need to advise Treasury of this exposure. And then 3 months down the track, euro dollar's moved. Your cost of purchasing your raw materials has gone up, and then your CFO rings you and says, "How come you haven't got any hedges in place?" If I don't have the information, I can't hedge it, right? So that's one of the major drivers of my frustration within an operation. I guess following on with that is staff turnover. You have a business unit that might be providing you timely, accurate information, every month or week, whenever it's required. Staff member moves on. You have a new staff member who hasn't been trained up, and suddenly that information flow ceases. So got to go back and do the training and try and get that information back in again. And I guess finally, lack of forward looking, providing information. So you may have an M&A that could be in the pipeline, which you haven't been advised about. So there's a funding issue at some point, or the business might be looking at a new venture in a different part of the world, which has a different currency exposure, and certain parts of the world have restricted hedging. You can't do forwards, you don't do spot. So without that information, you can't advise senior management of potential risks of doing that kind of new business. So I guess this lack of information comes through, gives rise to missed hedging opportunities, and also over hedging or under hedging, which then leads to a basis risk and an increase in P&L, and then you need to explain that to your CFO.
Thank you, Bill. Faidon, adding on what Bill explained, could you shed some light on the impact that FX and interest rate volatility can cause in the group's financial statements?
Of course, thank you for the question, Adiola. Starting with the FX, I would say that the risk can stem from two main ways. Transactionally, first, which is when the revenue or the expenses differ from the functional currency. So between the recognition day and the settlement day, the FX can create volatility, hitting straight your net income. On the other hand, translational, it's when we consolidate our foreign subsidiaries into the parent currency, and they are the most risk exposure because they do not cause any physical cash underlying movement, though they create significant P&L, which can hit both your balance sheet and your income statement. Unhedged positions, of course, can stem in both ways, can be a both-way trip over there. They can create profit or loss, but the role of the treasurer is to create FX-neutral revenue. It's actually to minimize the volatility in the income statement, and specifically net income. So I wouldn't agree more with Bill saying that the underlying data are equally important, because even the best hedge can fail if the underlying data are not accurate, are not timely, and they do not actually reflect the reality. On the interest rate, we can see that the main risk comes from the floating rate debt, and specifically from your borrowing costs. So your borrowing costs are increasing via the interest expense, and as such, they're hitting your income statement, which in their run, they impact the cash flow and the profitability of the group. Again, how much of that volatility you allow you to pass through into your balance sheet, it has to do with your hedging. So this is your hedging strategy of deciding how much volatility you want to accept in specific situations.
Thank you, Faidon. It is very clear, I would say, from your statements that visibility and accuracy are very crucial, but they remain still a real struggle. Kerim and Gilles, from your perspective, how can companies bring more control and predictability in the FX processes? Maybe, Kerim, we start with you first.
Thank you, Adiola. So throughout Europe, across our corporate treasuries, we see a clear trend in increasing demand for automation and digital FX execution. So to increase the predictability and bring control to the process, and also to reduce the errors, I think the automation helps greatly to the client base. So many teams traditionally use emails, phones, and Excel spreadsheets to follow their exposures, and also for the execution side as well. But this method is slow and also holds some operational risks, and then it has room for error margin, actually. So in the automation side, actually, using our execution management system, our clients are integrating their treasury management systems and ERP systems to the execution management system of 360T. This actually provides a straight-through processing NSTP between the systems that calculate and originate the exposures, the execution, and also then afterwards for the booking of the trades as well, which actually helps the clients to implement their FX hedging policies. So first, the clients can define their FX policies, and then they can implement this policy using a combination of the treasury management systems and our execution management system to go out to the banks and execute with this. So one example might be they can even use auto execution for the execution side of things. So instead of calling the banks and asking for quotes. They can digitally send the request, receive the quotes, and the system can automatically execute, for example, smaller tickets. And for larger tickets, they can implement audit-proof approval processes and manual execution for the site. So we actually see strongly, significantly reduced operational error and also an increased performance in their FX hedging for the clients who implement these systems.
Great, thank you. Gilles, on your end?
Yes, I couldn't agree more with what Kerim was saying there. I think what's important is to have a centralized visibility. So where you have system talking to each other and making sure that there is automation through workflow processes. So building that ecosystems where there are segregations of duties between front, middle, and back office can only make sure that, and system communicating between each other can only make sure that you give clear visibility to the management team. But also having that exposure management and forecasting where you have actuals, but also cash flow forecasting available on the one platform can always only ensure that management team are well informed of the exposures within the group at different currencies, different type of instruments, but also different type of subsidiaries and what have you. Yeah.
Thank you. Thank you, gentlemen. So we heard about the importance of getting accurate FX exposure. But as we know, FX risk, it's not only affected by market factors, but also by geopolitics. Bill and Faidon, I'm going again to ask you first. How do you monitor and prepare for risks like sudden volatility, like geopolitical shocks? And what do you find most challenging in explaining these risks to the senior management?
I'll go first. Yeah, so geopolitical events and market volatility can significantly impact financial exposure. So monitoring these movements is imperative, and trying to prepare strategies to mitigate them are also quite important. Trying to explain these risks to senior management does have its unique challenges. So you just want to keep going back to senior management with issues. So I guess that one of the key issues is to have real-time market monitoring. So we use various data sources, whether it's Bloomberg or Reuters or whatever it is, to help monitor currency movements, interest rate movements, commodity movements overnight, and that gives you your market perspective. But beyond that, I'm in a different time zone. I'm in Sydney, so most of the events are happening overnight. Mm-hmm. So I try and leverage off my banking panel. I get a whole heap of emails every morning, which gives me a rundown on what's happened overnight. In the past, you sit there and flick through each email and read and try and find out what's going on. But with the rise of things like AI, mm-hmm. ChatGPT, whatever it is, you can, Copilot, you can put those emails into these platforms. It can help you summarise it. So having that saves you a whole heap of time flicking through what's important and what's not in your emails overnight. But having the information is one part. It's more around understanding what impact that has to the markets and more importantly to your business. So, for example, there may be a tariff that's imposed in one part of the world which may affect one of your suppliers. You take that back to senior management and say there's an impact. It may cost us more to buy these things, so they go off and look at different supply chains. Mm-hmm. That different supply chain will be in a different part of the world. It gives rise to different currency risks. It might be in a part of the world where hedging is limited. You might not have a forward market. So having that information, timely information, is imperative to go to senior management. The communication is key with senior management. Like I said earlier, you don't want to be going back to senior management every 5 minutes with there's a geopolitical issue overnight. We need to go and do some hedging. It's going to impact our business. You keep going backwards and forwards. If nothing materialises, you lose credibility with senior management. So it's a matter of trying to filter through what is the important information and what's definitely critical to your business. So that's definitely a key to senior management and explaining what the issues are.
Thank you. Thank you, Faidon. On your end?
Indeed, geopolitical risk is surely very important. I would say that beyond the well-known conflicts that we see in Ukraine or the Middle East, we do see rising tensions in Indo-Pacific, Baltics, and unfortunately even the Northern Europe. As it was correctly stated, geopolitical risk is about expecting the unexpected, eventually. And at this point, I would like to bring a research conducted to the Treasury executives by the Bank of England back into 2024, simply asking them what's the most material risk you see. I would say, I recall that more than 80%, they replied that geopolitical risk is, firstly, the most impactful risk for their organization, secondly, the most challenging risk to manage, and thirdly, the risk that they see most likely to materialize into their organization. The way that we monitor the geopolitical risk is firstly from the very valuable research we receive from our consultants and banking partners, but also we prefer and we like getting the information straight from the field, speaking with our local customers, local suppliers, understanding the situation, because this helps us evolve and better deal with the situation as it evolves in real time. This is surely important because most of the times, in such situations, the narratives and the headlines with the real situation, they are very different. So the in-hand and the in-field information that we receive, it's very important in order for us to risk manage. Unfortunately, there isn't a direct financial product that is hedging you against geopolitical risk. But the way that we prepare and we prepare ourselves, it's through the reliable information and our quick reaction to such risks. I would say that the most challenging part when it comes to communicate with the senior management is that geopolitical risk, it doesn't directly hit your income statement. It has indirect hits through the supply chain, shipping routes, even the market sentiment. So it's our job, it's actually to translate words into numbers, translate through discount rates, through higher premiums, make it the risk tangible enough, explainable enough, and material enough to be communicated with clear numbers, clear narratives, and why we should react and how we should react.
Thank you. So it's what you have both said, it really highlights how uncertainty is becoming the norm, actually. So, Kerim, help us say what do senior managers typically expect to see in reports when volatility spikes, and how can Treasury teams make that easier?
Sure, Adiola. So during the times of high volatility, so when markets move quickly, the Treasury teams need to act fast, but with caution, for sure. So they need to ensure that the positions are hedged properly, and of course, with the best possible rate at the markets. So senior management would like to be sure that the positions are under control and they are hedged properly with the best possible rates in the markets. So to help with this, actually, the FX policy that's implemented clearly definitely helps a lot. So you can follow your policies, and using automation, using digital tools definitely supports the clients with these processes. So what is also expected by the senior management is actually that they want to be sure that the execution is done with the best possible rate, so best execution, so to say. To achieve this, we support our clients to connect to multiple banks at the same time, and then they can send the requests, FX requests, let's say for FX spot and FX forwards, to multiple banks digitally. They receive the quotes from the banks, and they can compare the banks together to see a clear picture of where the market is. And after the execution, they can also prove that among competition, they have executed with the best possible quotes. On actually top of that, after receiving demand from the market, after seeing this, we have launched an FX data feed based on the execution done on the platform with the real live quotes coming from the global banks, actually. So that also gives a clear indication of where the FX rates are in the market. And during the execution, we can add this as a benchmark, for example, show this as a benchmark to guide the treasurers. And after the execution, we can add this as a benchmark. So they can even compare that. In addition to the competitive quotes, they can also compare their execution rates to the FX benchmarks. So combining this, they can make sure that they are executing with the best possible rates in the market. And adding on top of this, a clear implemented policy with the approval rules, with a proper way to create orders, approve the orders, and execute them. They can also log all of these digitally. Combining these, they can make sure during the volatility that they are executing with the proper workflow. And this way, they can make sure and they can show to the senior management that they are following the best possible practice. And finally, that helps to build trust and transparency within the company.
Thank you. Thank you. Gilles, how does your system help treasury teams monitor, model, and prepare for such risks in real time? And additionally, what tools or reporting features within your platform best support explaining this complex risk to the senior management in a clear and actionable way?
That's a very good question, Adiola. I think on the first point, there's two things. The first one is early visibility, and the second one is scenario decision making support. So on the first one, early visibility, just like Kerim mentioned, it's important for you guys to have a centralized view, whether it's from interest, FX positions, commodities positions, intercompanies movements. Having that clear visibility at an early stage can help you know where your exposures are. The second part is around making sure that we can scenario test or simulate the impact of movement on the market, rate spiking, FX dropping down. What would be the impact from the P&L point of view? And also, combined to that, having live market data, generally updated on the system every 10-15 minutes, can help you know whether or not, from the valuation of your portfolio, if you are in or out of the money. When it comes to giving clear advice and information to the senior management, it is important to make sure that you have scenario dashboard reports available. First of all, making sure that you can, from a stress test point of view, being able to stress test the valuation of your asset. So our tool could help you get forward mark-to-market based on scenario market data. You could also do complex valuations such as CVA, DVA, and FVA if necessary, and present it with dashboards showing graphs, pie charts that would show the impact before and after you've got your hedging strategy in place. I think all these tools can only help our clients present clear, simple reports to their board and then from there make decisions that will be protecting them from any impact on the market. Yeah.
Thank you, Gilles, thank you. I believe that we all agree that having a robust treasury policy is key to aligning hedging with strategy. Bill and Faidon, how do you balance the need for plain, straightforward hedging with the benefits that, the potential benefits of more synthetic and more complex instruments? And on top of that, where do you see the main challenges of implementing your policy in practice?
Yeah, I've got to agree. Having a robust treasury policy is imperative for risk managers and the treasury team to put in effective hedges and mitigate the group's exposure risks. I guess like any tradesman, without the right tools, you cannot do the job properly. So I think we need a robust treasury policy, especially in times like we have at the moment with volatility, geopolitical issues, Trump 2.0 and the rest of it. So having a treasury policy allows us to do various things is very important. So the policy should clearly outline what products can be used, from your straight vanilla forwards, future contracts, to something more complex, swaptions, options, accumulators, whatever it is, having that in place can take advantage of market movements. The key is that senior management needs to understand what impact these type of derivatives can have to your P&L. And if there's one thing that annoys senior management more than anything is a surprise. So having senior management understand what each product does is important. So in my view, you need to have a balance of both. So for example, if the forward market, the forward curve is in your favour, maybe a straight out long dated forward is the way to go. In times of spikes in volatility, the use of options, especially selling options, if your policy allows it, can take advantage of that increased premium you will receive from selling options. Another great strategy is the classic risk reversal, selling an option to pay for a bought option. In times of volatility that has collapsed, and it's below long-term averages, it could be a great strategy to go out and purchase an option. So having that ability through your treasury policy can help in volatile times. The issue is some of these structures aren't hedge accounting compliant, so that can create noise in your P&L. Once you do your mark to market, it's got to sit in the P&L, and senior management needs to understand what that impact is to their numbers. Now, I guess another thing with a robust policy, you can take advantage of some arbitrage opportunities in the market. Something we've seen quite often is if you have a debt facility that allows you to borrow in a non-basis currency. So, in Europe, you might be able to have a debt facility that allows you to borrow in US dollars. Then you can do a cross-currency swap to eliminate the FX risk back into euro. And in times of illiquid markets, the cross-currency swap can add some benefit to your funding. So you can pick up an arbitrage from borrowing and pick up a number of points on your debt funding. So again, a policy which allows you to enter in a cross-currency swap helps you take advantage of that market risk. And I guess, so the key is to make sure your senior management is aware of any potential P&L impacts. So yeah, I think that it's imperative to have both.
The preference, I would say, stands with Delta One products, plain products, because they have clear accounting treatment, their impact is easy to track, and they follow with close correlation the underlying exposure. But given the complexity of the industry, there are situations that we have to get involved into more synthetic hedges, into more synthetic structures like the cross-currency swap, which they have multiple layers, which they don't only provide hedging effectiveness, but also they can alter your profile of your debt and even impact your cost of funding. Speaking about funding, there are situations also that we need to match the maturity and the duration of our balance sheet. So such kind of structure help us optimize our funding needs, make them more predictable and make them more steady, providing a safety umbrella into our net income. I would say that a treasury policy, it's very important about a treasurer because it gives clarity, it sets specific boundaries where the treasury can move, and it's an agreed framework with the business. It's actually, I would say, a contract with the business, how treasury is supposed to perform in specific situations. But a complex policy, it doesn't add any benefit. I would say it actually creates exactly the opposite. So a practical and applicable policy, it's very important for us because it needs to be handy and it needs to be clear in situations where you need to understand it and you need to act fast eventually. I would say that the challenge is not to the forwards, to the current swaps, to all these exotic instruments, but it stands about bringing the right people on the right table, acting on the same time, speaking about the same matters and taking a common decision. And this is what we find the most challenging, but also the most important, to bring everyone on the table at the right time and take a timely decision.
Thank you, Faidon. So, Kerim, how can automation free up treasury teams' time so they can spend more time on providing with strategic solutions the business instead of getting stuck in execution?
So, Adiola, that's a very critical question, very critical topic. So, automation actually enables the treasury teams to automate some routine tasks and processes, which will save time for them. And instead of spending valuable hours to call the banks and calculate the exposures, track the sheets, and wait for approvals, and enter the data again and again to multiple mediums, actually they can use technology to automate all of these steps, and then they can focus on more strategic topics, on the strategy, on FX hedging side, and on the balance sheet and liquidity topics. So, for example, a way to improve an end-to-end workflow example can be using the exposure data coming out of the treasury management system. The corporate treasuries can upload them directly to an execution management system in FX swaps, spots, forward trades, or NDFs as well. And then they can use rules to manage these exposures in terms of orders, tickets, in the execution management system, send it to the banks and execute. And after the execution, they can export the data back to their systems for the booking. And on top of that, for confirmation matching with the MT300 messages and everything, they can also export it to the third-party confirmation management systems to do the Swift confirmation messaging, which actually saves a lot of operational time for them. This reduces also the error margin that's actually comes into play with the manual processing that's coming in between. And this definitely helps the treasuries in the way of the automation. Also, trend that we see increasing is more and more is the interest in FX options space, as also our treasury colleagues have mentioned. Just so using plain vanilla FX options or option strategies like risk reversals is possible to create or even upload from a treasury management system directly, or possible to manually create within our systems. And these requests also can be sent to a multi-bank environment in competition to see actually the best possible premiums, prices. So that's definitely also in addition helpful for the clients. So in general, what we see is, of course, mistakes happen when people are too busy during times of change, maybe with the turnover, and actually having a clear FX policy that follows the system and implementing this with digital checks and automation actually helps to cope with the change as well. When you have new team members during their training, etc., to avoid any issues, you can have clear checks in place that are implemented digitally. And if they follow this policy, then every time the automations, the rules work the same way. So it is totally independent from the turnover, from the team. So it's a clear way to use, actually, to minimize the error margin and help the new team members. And at the end, it helps to create a stable and trustable process within the company where the team members can freely develop more and improve themselves and also improve the processes they have as well.
Mm-hmm. Thank you. Great. So, Gilles, on your end, when the strategy is set, how can platforms support treasurers in executing more complex strategies, hedges in effectively?
I think what's important is to know that once this hedging strategy are put in place, the system would help you, first of all, ensure that those execution are in place efficiently and also align with the treasury policies. My colleagues here were talking about swaptions and complex type of instruments that are sometimes very difficult to value because you need the right set of market data, first of all. And then there are methodologies in terms of if you want to do hedge accounting, for example, you will need a system that would make sure that you can build in a hedging strategy and then run the effectiveness testing based on your reporting period or frequency, whether it's quarterly, whether it's monthly, whether it's annually. And also having the right level of support when it comes to auditors' questions. So it's important for you guys to know that having a tool that would help you run those sort of reports that can be quite complex, not just complex to build, but also to understand and explain to the senior management team or the editors. Having that support behind you is key. And then once that's in place, it's important to be able to have dashboard monitoring, for example, having limits in place based on counterparty credit limits, where okay, you have the counterparty credit ratings in place, you're monitoring your notional against some of these counterparties, and you have warnings where you're saying, okay, limits are breached, would help you guys track those policies. And the final thing is to make sure that once all of that is in place, we have that segregation of duty, these rules and these controls, through dashboards, through reports that are real-time updates that can help monitor these hedging strategies.
Thank you. Gilles, I have what you have said is very, very interesting, and that's why I have two more questions for you. The first one is, what lessons have you taken from recent disruptions, for example, energy shock, supply chain volatility, in terms of maintaining liquidity buffers and access to contingency funding?
I think what we've seen is that the recent disruption within the energy sector, the shock in the market, the tax from Trump has highlighted the need for robust liquidity monitoring. So being able to see the impacts from the cash flow point of view is key and is vital. We've been in scenarios where because of the volatility that we see in the market, we have more and more people relying on additional market data sources, updates from their banks, updates from the market data providers to actually help us put in place strategies. So it is important for us to, and we've seen a lot of business planning requests where we're saying, look, we want you to help, we want to help our clients review and assess the business plan, making sure that it's aligned with, first of all, the group policies, it's aligned with the group strategy in terms of growth, and readjusted regularly based on what we see on the market.
Great. And my second question is exactly that. So how are treasury teams aligning their financing strategies with the longer-term plans of the business, like mergers and acquisitions, funding expansion, and CapEx, while at the same time maintaining the financial flexibility?
Very good. I mean, it's important to highlight that, it's important when the financing strategies are in place to involve everybody in a discussion, especially the treasury team. So whether it's one key area such as, reviewing the capital structure, making sure that the covenants aren't breached, making sure that you have your interest cover, for example, are not going to be breached. All of these things, we've seen a lot of requirements on advice, from an advisory side, to help, make sure that, the strategy, the market volatility is all aligned, and we can actually put in place hedging to actually avoid movement within the P&L. So we stress testing regularly the business plan. We're putting assumptions in place just to make sure that the strategy aligns with the hedging policies, and we have the right people discussing about these strategies. Yeah.
Wonderful. So we have heard today about the challenges of exposure visibility, volatility, strategy alignment, and how the advisors can assist with processes, reporting, and technology. But before we close out our session, I would love to hear from each one of you what's the top steps that you believe treasurers should take tomorrow to manage FX risk. Maybe we'll start with you.
Treasury operations can be and are complex. So pinpointing one specific step is all dependent on how established your treasury team is. You know, if you don't have a treasury policy in place, and looping back to the previous question, if you don't have a treasury policy in place, I think that's step number one. You need to build a robust treasury policy. And then beyond that is having, you know, again to the previous question, is having that data flow, timely, accurate data flow coming through. So, you know, I'd say that's step one. Step two would be having the data flow. If you're in an established treasury where these things are flowing, you've got a treasury policy, the top step would be to start streamlining and automating some of your processes. You know, I mean, 360T is an example. I've used it for years. Having the ability to hit a platform and that goes straight through your treasury system, the straight through processes, you know, saves a whole heap of time, input errors, and the rest of it. So that's you know, one of the streamlining things you can do. But I guess for me, we need to take advantage of AI. It's here. It's still in its infancy, but it's moving very quickly. So in an established treasury, we need to look at how we can leverage AI to, you know, help us manage our cash flow forecasting. You know, manage. Maybe you can use it for confirmation for your settlements. From an FX perspective, you know, currently you'll go to your banking panel and ask, you have an idea about doing an option. You go to your panel and you've got to tell them what specific option you want to do. And they've got to go away, get it priced and come back. You know, using AI, you can go in there and say, okay, where's the sweet spot? Where's the delta? Where's the best, you know, derivative I can use? The forward market, they can do all that analysis for you, and then you can go and get it priced from a bank. So all that work's done before you go to a bank. You can also have the ability to use AI for debt documentation processes to assist in doing stuff like that. I guess the issue with AI, and I think it was raised in one of the earlier panels, is that having that security. You don't want any data leaked. You need a closed AI. You need senior management buy-in. You know, it can be costly. And what product do you use? So I guess we're in the infancy, but I think the step forward is to look at, you know, maybe an AI to help with the streamlining processes, so you can save time and focus more on risk management.
Thank you, Bill. Faidon?
From my side, I would highlight the accurate and timely data, because without these two, even the best hedge can fail. But in practice, I see this as three interlinked pillars eventually, which is accurate underlying data, clear accounting and understandable accounting impact, and ability to act fast. On the latter, I would say that we live in a world where yesterday's news are already written in the history books. And I would like to bring an example about back in April 2024, we saw a 4% roughly appreciation of the Japanese yen against the US dollar, and this was just in a single hour. And imagine we're talking about a currency pair, which is among the most liquid and the most advanced in the world. The volatility in emerging markets and the Middle East and other regions is even more extreme in some cases. So the ability to act fast, it's the most important, and it comes from having accurate data on the back of your hedges, on the back of your decisions. But sometimes volatility can come from within the companies, and this is where the accuracy, again, of the data plays a role, because, again, inaccurate or delayed data can undermine a perfectly designed hedge, and this can sometimes, be out of the hands of the treasury to manage. As such, I would like to conclude that strengthening your FX needs clear data, good understanding of the accounting impact, and eventually application of your treasury policy, application of your strategy, and aligning your strategy with FX neutrality, avoiding volatility in net income, rather than trying to avoid and breaking results in terms of P&L into the group.
Thank you. Thank you, Faidon. Kerim, on your end?
So one of the best steps for the treasurers can take is to begin their automation processes, actually. So I think automation is a journey, and it doesn't have to be one tremendous step that happens once, actually at once. So what we actually observe more in these implementation and success stories, that most of the teams make it just step by step. They, for example, first step into the multi-bank execution. They just start to use a digital platform to send the request to multi-bank environments for execution. Then the next step, as they improve their FX hedging policies internally within the company, they start to implement the other digital tools to support this process as well. And step by step, they implement the integration between the systems. And in the meantime, they build internal processes, they add approval rules, and finally, they can go up to auto execution to actually reach a no-touch trading experience. Also, automation is not just about speed, it is about building consistency and also structure. So when the processes are well defined, when it's implemented in the system, then it's actually easier to follow, easier to improve, and then easier to manage as well. So this reduces all the operational risks and improves operational performance of the treasuries significantly. And then it allows and gives the room for the teams to develop and increase their performance over time.
Great. Gilles, what's your opinion?
I think it's important for treasurers to first of all embrace technology. I think technology is moving, and it's important to be part of that trend, that movement, because it will allow treasurers to first of all have a consolidated view of the exposures. Mm-hmm. So it will help treasurers know where the risk sits and act swiftly. And with that technology, what you would then be able to do is to put in place strategies based on the policies that the group have set, and monitor those strategies that they align and they're not breached. Technology is there and is always going to be there, and is always going to move ahead with the demand of our sector in Treasury. So it's important that we embrace that trend. Bill mentioned AI. It's going to be part of Treasury technology in the future. So it's not to be afraid of that, but it's just make sure that we are fully aligned with the trend and movement that we see at the moment.
Great, thank you. Warm thank you to you, Gilles, to you, Kerim, to Bill, and to Faidon, and of course, thank you everyone for your attention. Thank you.